Folks, welcome to the Midweek Roundtable. We have our usual co-host, Jeff Zananeri. My name is Roger Scott. Please welcome. And folks, if you want to reach out to Jeff, please do. He wants to make sure your questions get answered. His email is jeff@joyofthetrade.com. If you want to reach out to me, support@marketgeeks.com. It'll get that way to me directly. If you try to send an email to Wealth Press, it'll take 5 people before it gets to me. Anyway, Jeff, how are you? How are you doing today?
I'm good. How are you?
I'm doing pretty good. It's Wednesday. The market's going to open up in just a little bit. I feel like we're in a very interesting time right now. Earnings are just passed. Market's looking for another catalyst. Inflationary pressures it doesn't appear to be going anywhere. More issues with China. The world keeps turning, they keep spinning.
It always does. We've got Sleepy Joe is going to announce the new Fed governor, he said, within days. So the market's kind of like antsy for that, I think.
Right.
Rates popped back up. We were spot on about that. You see interest rates starting to creep. Market's not really reacting negatively.
No. And I have a theory about that. My theory is that the bond market, a lot of traders don't realize that the stock market gets about 2/3 of its volatility from the bond market. The bond market is what drives the stock market. Currencies drive bonds, bonds drive stocks. It's just
and FX is the most liquid market.
Exactly. And 1,000 times bigger than the stock market,
Right.
A lot of people don't realize that the size of the currency market.
A lot of people don't realize a lot of things.
That's true. That's why you and I are here.
Right.
I believe one of the biggest reasons why the bond market is not crashing and burning right now, especially with the data that came out yesterday, is because the bond market is anticipating some downside from the stock market, especially chips and software.
That is exactly what I was starting to think. I was starting to think that the bond market is like 1 foot in, 1 foot out. They're waiting, like it's almost like a pitcher that's like about to throw a ball, but waiting to see if someone's going to steal the base. They're waiting to see what the stocks do. I think we're going to get some kind of shakeup that is going to create like a little bit of a panic before the end of the year, but it's going to be short-lived. And I think that you will see bond yields like ripping into the next year. And I think stocks will get pressed higher to close 2021 because that's how money flows work. We talk about this all the time. That's what fund managers do. They're not going to allow their bonuses to go bye-bye now, when the performance has been so good in stocks this year.
And statistically, November, December, and January are the best months of the year. During that period, the S&P on average gives us 4.54%, while the Nasdaq gives us over 6%.
Exactly, particularly in years where the S&P is up double digits.
I would imagine. So I don't know the breakdown on that, but I would imagine it's pretty good. I mean, there's a lot of liquidity still moving into the market. And while I do believe the consumer discretionary stocks are going to fold a little bit and cool off, they've been running just too hot. I think consumer staples are actually getting ready to make another move higher.
I like that switch. I like that switch out of.
Well, they're more defensive. They're the Home Depot, the Walmarts, the Targets. Their numbers have been very, very positive. And I think with the end of the year, I think we're going to see more. I think we're going to see more of an influx into what people need versus what people want.
True.
I think that's what's happening.
Speaking of need, let me ask you a question.
Yes.
What does this economy need the Fed to do?
What does this economy need the Fed to do? I'll tell you what this economy needs the Fed to do. Number one, stop making wild predictions about the future where they have absolutely no idea what the hell's going to happen. That's number one. Number two, stop trading again. Stop putting money into the market. That would be another one. I mean, we thought that was kind of obvious.
Guys, yeah.
I mean, we thought we were kind of obvious. Honestly, we need a real leader. We need a real leader in the Fed, somebody who's going to step up and look like a leader and appear to be a leader. I don't think I've ever seen Fed get so little respect from market participants as the current administration.
They don't have a lot of credibility. None,
as far as I'm concerned. So
Yeah.
I think they're doing a lot of things bad. I mean, we could probably talk an hour about what they could be doing differently. I mean, the way they've dealt with the way they started moving the yield curve way.
So you think that, let me ask you a question. So you think that Brainerd would be good as a change?
Not so sure it would make not much of a difference. I'm not sure Brainer's the right guy. I'm not that hot on him.
Oh, the lady. I'm sorry. I was talking about the lady.
Yeah,
She's very dovish. She's super dovish.
yeah. I'm not very hot on her. Yeah, just not feeling it. Not feeling it at all. I don't like the statements that she's been saying in terms of the long yield versus the short yield. I don't like the iffy washiness that they've been going through. I just don't feel it. I don't feel it. I think we need somebody new, somebody maybe a little bit younger, somebody maybe a little bit more in tune with what's going on. And again, look, I'm not 25 years old, okay? So I respect older people, but I think that this Fed is just out of touch. They're totally out of touch. I don't think they're digital enough. I think we're moving into a part of our economy that in our economies because I mean, look, they're talking about changing the name of the Staples Center. It's crazy.
You have to go with the flow. You have to ride that wave. You have to swim with the tide, and that's taking over the world. And it's not.
It is. It is.
Whether you want it or not, it's the way it's going.
And I honestly, Jeff, I honestly don't feel like this Fed is in tune. They're not talking about gold. They're pretending like gold doesn't exist anymore. Yeah. They're talking about inflation in a very, very like almost like a moving average. Like they're looking at a 200-day moving average. They're not ahead of anything. They're too.
Yeah, they don't think that. This is the stupidity with how inflation is analyzed. Anyways, there's like equal weighting to what the price of tires are compared to what the price of bread is. Like you have like revolutions in countries if bread goes up too much and inflation goes hyper on food. And so the fact that they have no like humanity in discerning like rent, housing costs, energy costs, food costs being explosive tells me that they're just like, they're so out of touch because they are like these guys that are sitting in this crystal tower day trading S&P futures ahead of their own policy. And I think it's going to backfire. And I think there's going to be a populist reaction. I think that there's going to be political pressure from both sides, from the Republicans and the Democrats. It's not going to be a political situation that either one is going to want to go against. And right now, as it stands, the Biden administration is looking at it like, well, we don't want to get blamed for inflation because of our spending packages. But at a certain point, they're going to point the finger at the Fed and say, it's their fault. It's not our fault, their fault. And so I'm wondering when that happens, because nobody in politics wants to get blamed for not being able to put food on the table.
Right. Absolutely. I couldn't agree with you more. So yeah, I think we're going to have some major changes. And again, I think you're very right. I don't think it's going to be a Democrat versus a Republican issue because this is just a very, very broad issue. And I also think Congress has to start making more laws regulating the Fed a little bit tighter. I think they've been getting way too much free reign, and I think they need to go under control a little bit. So
let's check. Can I change gears? I've been wanting to pick your brain about this one sector because you're so damn dialed in on it. Semiconductors. Some of these chip stocks have ripped like crazy. Where are we at in the cycle?
That's a great question. Boy, I got a lot to say about that. I have a lot to talk about that. So I think that one of the biggest reasons that we've seen this rally sustain itself in consumer discretionary, the XLY, is because of the semiconductors. If you look at ticker symbol SMH or $ SOX, which is the index. One is, this, but I want to make sure that people at home know this. One is an index, one is a tradable asset. So if you want to look at the index, it's $ SOX. If you want to trade it, it's SMH. That's like the ETF, the biggest ETF semiconductor, and it has plenty of liquidity. And I've been looking at it. Let's put it this way: I'm right now shorting the weakest stocks in the semiconductor index. I'm shorting Micron right now. Yeah, I think that I think the catalyst. Here's what I think.
So
A
there
few
we go.
things.
That's what I was waiting
Yeah,
for.
here's what I think.
Nice.
I think I'm going to give you a lot of information here, and again, I don't know if I'm right, but this is what what I'm thinking.
I like it.
The semiconductors are grossly overbought. Most of the pressure we've seen from the supply chain is priced into them already. The earnings for them have passed on already. There's no major catalyst for them at this time.
Right.
We already know the situation for the next quarter with semiconductors. We already know that a bunch of people are going to be buying tech and not getting it for 6 months. We know that.
True.
So I'm at a position right now, and I follow chips very, very closely. That's one of the sectors. That's like one of
That's
my.
why, man. I was like, I'm watching some of these names, and I'm like,
yeah. So a lot of when I tell this to my guys, a lot of them are telling me, well, Roger, if that's the case, shouldn't it impact the overall market? No, because we have a lot of basic material and industrial and solar stocks that are actually pulling up and are looking really good. The small caps, if you remember last year, the small caps had their best period between November and January. They are right now outperforming large caps. So I think what we're going to see is, here's how I think this is going to play out. I'll give you the full dynamic. Okay,
I love it.
I think here's, and I have very strong conviction in this. About 30% of the QQQ is chip stocks. Okay, 30% of market cap in the QQQ is chip stocks. If you look at the QQQ and if you look at the chip stocks, they're mimicking each other right now. I mean, it's like looking at the same graph. Yeah. I mean, the slope on the Dow's like 40%. The slope on the Nasdaq and the chips is like 8. It's like parabolic. So yeah. So I think we're going to see less of a catalyst. I think they're going to come off because, again, the market prices in everything way, way ahead of time. Yeah. And we've been talking about the supply chain shortage now for a long time. We've been beating this drum for like 2 quarters now. So I think there's very little in the way of catalysts driving these chips higher.
Great.
So I think they're going to decline, go back down to their base. And I think that's going to put market cap away from the XLY, the consumer discretionary, and back into the XLP, which is the consumer staples, which are right now, if you look at they're right now at the breakout level. Matter of fact, let me share the screen real quick, okay? I want to show you this real quick here. So take a look at this, Jeff. See, take a look at consumer staples where we're at right now. We're breaking down a little bit, but look at where we're at right now. And look, nice smooth trend, right? Nice, even, fluid. Looks like it can go higher.
These are the consolidating. This is basing here.
Exactly. And now look at the consumer discretionary. I mean, look at this thing.
This woke me up to why this is there.
And now, okay,
this far here when it broke.
So I think we're going to kind of test the high, kind of come up here a little bit, and then fade away. And now look at the semiconductors. Tell me they don't look exactly the same way. It's the same thing.
Semis are starting. They're going to start to roll here. I think.
Yeah, I mean, look at this. It's coming off. I think so. So here's my. I think this is going to cool off.
Yeah.
Volatility, which you're big on, is going to increase like there's no tomorrow.
I think we'll get a nice pop here soon.
Yeah. So I think that's the dynamic I'm looking at. I'm looking for a cool off in the chip stocks, in the Nasdaq 100 stocks, and here's the Nasdaq 100. I think that's going to, again, Nasdaq 100 and look at Nasdaq 100 and XLY. Tell me they don't look identical right now. I mean, look at that. It's the same thing. It's the same chart. So I think that's going to lose ground at the expense of consumer staples. So if I was a betting man, I would be spreading consumer staples long, and I would be doing consumer discretionary short. I know you like pairs, so I'll stop sharing here. But that's
great. That was a great technical breakdown. You tied that beautifully. I was really just looking for because I was feeling the same thing. And semis are starting to get they got stretched. I'm starting to see some sagginess from the weak ones that you've pinpointed to be bearish on. Yeah, and there's a big correlation between consumer discretionary, obviously, with iPhones and computers. And that's a major component of what people buy with the discretionary income. I'm not sure that's appropriately titled discretionary, but it is. It's still included.
It is. And the deeper we get into technology, 50 years ago, technology and consumer discretionary, two different things. Now it's a very blurred world. I mean, is Apple a consumer discretionary or a tech stock? Is Amazon consumer discretionary or a tech stock? So you see, you have the lines are getting much more blurred right now between tech and consumer discretionary. But before we conclude, I wanted to ask you one more question.
Sure.
What's your view on China? They've been having some news released. They're trying to. It looks like they're trying to create another exchange for businesses. What's your take on all of this? Give us some
a little bit
updates.
schizophrenic. They're playing. For me, it's tight. It's like bring your enemies closer, right? Like the Godfather said, keep your friends close, keep your enemies closer. Like they probably went a little bit too far in the summer with a lot of like their aggressive actions against profit-making endeavors, right? And now they've kind of like, they had that Xi Jinping and Joe Biden had like a nice, warm, cozy, semi-cozy conversation.
Nothing was resolved. Nothing was
being
resolved.
sarcastic, right? Like, so I think that nothing's changed underneath the hood. It's all bullshit. It's like they're bluffing on trying to play nice, and their actions are all still anti-capitalist, anti-Western, aggressive to their regional partners, anti their own corporations. So invest in China at your own peril. I mean,
right.
Like when you got like some of the biggest investors in the world that wouldn't touch it with a 10-foot pole, I'm with those guys.
Gotcha. I wanted to ask you, and I always ask you this, feel free to say nothing or to answer. Again, I don't know where you stand.
I know I have it. If I have an opinion or I know, I'll answer.
Yeah. I just want to know where if you want to give our viewers any ideas on any pair trades you're looking at, and you don't have to give specific tickers. You can just talk ideas and industries if you'd like. I just want to give some food for thought for traders out there who may want some ideas looking into different things.
I really like the IWM short arc trade.
IWM.
So you're IWM, long Russell, and short Cathy.
That is brilliant.
This is
brilliant.
I always go back to the well if something works, and I've hit it a couple times.
I love that. I
just reintroduced that trade recently, so I think there's still a lot of meat left on that bone for people out there that haven't traded that. And I think we closed the year with the tale of two stories, the tale of two cities, which will continue into 2022 with Main Street USA healing. And some of like the incredibly high nosebleed valuations and growth companies being compressed.
What's really interesting is I did not know what you were about to say. I had no idea. We don't talk before this convo. I had no idea you were long small caps and short tech. But it's very earlier in this discussion. What did I say? I'm looking for small caps to outperform, and I'm looking for tech to cool off. So.
Yeah, and it's been working. I mean, IWM's been great, and ARC we shorted it perfectly. We timed in last week. Few percent higher, like 4% higher from here. We should have looked at the ARC chart too. Next time we will. But it's super saggy. It's starting to roll over too.
And consider the XLY bear and XLP long. Not all that different from what you're.
You helping me. I love talking to you, Roger, because you solidify what I'm already kind of seeing, but from like a fresh approach and like, super data driven, which I love too.
Well, I'm glad to hear that. And Jeff, another great session. I absolutely love these sessions. I really look forward to these because I get to learn a lot from you, and you have a very good view of the international markets and the different.
So next week is Thanksgiving. Let's just like close it out with that. So we're gonna have obviously Thursdays off. Wednesday, I still have this discussion. We can preview Black Friday.
Sounds perfect. That sounds fun.
That's always a big event in the market.
Sounds fun. And folks at home, if you want to reach out to Jeff, please feel free to do so. It's jeff@joyofthetrade.com. My email is support@marketgeeks.com. Jeff and I have a really exciting time presenting this for you guys, and we have a fun. This is not rehearsed. This is totally unscripted. We don't prepare for this. We want you guys to get the best of our analysis and hopefully try assimilating this into your trading as well. Exactly. If you want to reach out to us, please feel free to do so. And if you want to learn more about Jeff, go to joyofthetrade.com or go to wealthpress.com. And you can find me at wealthpress.com as well. Reach out to me at support@marketgeeks.com. Jeff, another great session. Any last parting words before we depart?
No, it's this is probably the last full week of trade. Like people really start getting a little bit like soft right around Black Friday. So this is going to be an interesting week to see. I mean, there'll be events happening, but it'll be interesting.
and I'm waiting, and I think we're going to see a rise in volatility, and that's something we're going to talk about later today at 12:30.
That's
so
right.
I will see you then.
That's right. Take care, Roger. Thank you.
Bye,
so much.
guys. Thanks, Jeff.
Bye.
I'll talk to you soon. Bye, everyone.